Hey, like they can say nice things and the economy is doing this or that, but they're going to have to lower rates. That's the upshot. The pivot's coming, right?
Yeah, the pivot's coming. I think, though, if the Feds indeed shrink the balance sheet, continue to shrink the balance sheet, which I suspect they're going to continue doing, decrease the monetary supply, M2, I think that rate decreases most likely could occur somewhere out about a year from now.
You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
And welcome. You are listening to watching the Financial Survival Network. I'm your host, Kerry Lutz. Well, the Fed hath spoken, and has it spoken clearly? Do you know what the Fed did yesterday? Sometimes doing nothing is a lot more than doing something. And here to discuss it with us right now is David Wright, financial expert and proprietor of the Wright Financial Group. You find him at wrightfinancialgroup.com. Hey, questions, comments for myself or David or anything else about the economy, stocks, etc., just shoot me an email, kl@kerrylutz.com. David, it's great to have you on the show. So the Fed has spoken, or shall we say they haven't spoken. They didn't raise hikes. Were you surprised?
Not at all. I think most of the economists predicted it would be a nothing burger this time. The big question is, what are they going to do with the remaining two meetings of this year? Kerry, they've kind of gotten themselves into this predicament that if they raise rates any more than they do right now, they risk even more demand destruction and bank stress, things that are going on. They felt right now that the economy's in a good enough place. Things are kicking along. We had a recent IPO of ARM that came about. That went pretty well. It's doing well. But the economy right now is in an up and down state as far as consumers are concerned. I think they're looking at the auto strike. I think they're looking at consumer debt. I think they're looking at a whole host of things, Kerry, that are of concern to them. Raising rates right now could just break the backs of banks and consumers, as well as companies and their future earnings.
Right. All right. So it's better to do nothing than to keep pushing it. What of the banks? The regional banks, past few days were getting hit pretty hard. Seems like maybe they're bouncing back now, but they seem to be a key indicator. The other indicator is that the Fed's emergency discount window borrowing program to keep the banking sector afloat every week has been going up. So to this uneducated eye here, David, it really looks like things maybe aren't that good in the banking financial sector.
Well, they certainly are, because banks have to mark their books mark to mark what their loans really are worth at any given time. And with mortgage rates being double the rate they were 2.5 years ago, mortgage activity has greatly slowed down. I look at my own situation where I live. We're trying to downsize, right size, unintended, of course, but we're trying to right size, and we want to make it a cash deal from our house to another house. So right. If we want to upgrade a little bit more from where we're at right now and finance any of it, who wants to finance it at 7.29%, right? So all those things are playing into bank profits. Profitability of banks are under question. But I think the bigger question is, how will the Feds continue to manage this sticky inflation? Inflation has made progress, Gary, a lot of progress. It's come from 9.1 last year, as I'm sure your notes will indicate, down to roughly now. I think CPI, headline CPI was 3.7. Core CPI dropped a little bit, but the Fed's really look at core PCE, which comes out at the end of September. But it's still pretty sticky. I think what the Feds are going to have to do is this. I don't see them raising hikes in November or even raising anything in December. But what I do see them doing is shrinking the balance sheet. I think what they're going to have to do is all this 4.5 trillion they printed during COVID stimulus, all of those treasury bonds they purchased to inject cash into the economy, as those treasuries start to mature, they're not going to reissue them. They're going to let them roll off. They're going to diminish the monetary supply from all the Federal Reserve banks, which in effect will cause inflation, I think, to drop just by tightening the money supply. So I think that's going to be how they regulate the inflation in the future, not by more rate hikes. But there are plenty of people on the other side that say, I think you're wrong. I think they're going to have to continue to hike because you look at oil right now, over 90 or around 90 a barrel. That's going to hit all the American consumers with gas prices next year. When they go to the pump, that's going to shrink their budget. It's going to hit companies. It's going to hit the trickle down for all manufacturing and retail when gas prices go back up. And don't get me started on this climate change and EV movement. It just, all this stuff works in this one big bubble that it's going to be hard to get out of.
Right. Well, yeah. And not to mention the deficit's running a couple trillion a year. And we got a surplus of treasury debt on the market. And the dollar keeps going up. We got war in Europe and potentially in other places. So this balancing act, it seems like the Fed's balancing a lot of plates. They're like that guy, the contortionist, spinning plates all over the place. But at some point, the plates are going to break, right?
Yes, I think so. And it is part of it's the Bidenomics, the presidential stance on a lot of the things that are going on right now with climate change. I'm not against climate change. I'm not against that movement, but to completely transition over to EVs in California by 2032, it just isn't reasonable to do that. We need fossil fuels to create parts for those EVs. And if we're under a situation where the current administration says they're pro-union, if they're really pro-union, but they're backing the EV market, we know that 40% less workforce is required in EV manufacturing. And that trickle-down effect to all the suppliers of EV vehicles. So all of this stuff is going to contribute to, I think, a lot more unemployment, demand destruction. So, we're I think in a heap of trouble for the moment. It's a balancing act for sure.
It's a balancing act. So M2, all right, velocity of money keeps going down. That's generally a bad thing because that says deflation. Yeah, inflation was at 9-point-something%, but you and I both know, David, the actual inflation rate, the real inflation rate, substantially higher in double digits, right?
Of course. Well into double digits. I don't have the exact number, but I can prove it to you. I mean, when the Fed has made that, what do I want to call it, a brain fart of saying that the inflation is transitory. Come on. Inflation is never transitory. It's permanent. It's what the rate of acceleration is.
Yeah.
Maybe the rate of acceleration has decreased from 9 to 3.7 or 4%. But the reality is I have clients that are doing very well, and I have some clients that are just getting by. How do I know it's an issue? Inflation being a problem for them and the monetary supply shrinking. Just yesterday, I had somebody walk in with their 401k account, and they said, I need to cash this in. I have a house payment I got to make. I got to cash this in. I had somebody else I had an appointment with on Zoom yesterday, Kerry. There's someone that is ready to retire. They're near their retirement, and they've got over $50,000 in credit card bills, and no way of getting out of that unless they use their retirement accounts to pay them off. Consumer debt, 401k loans, and credit card, increasing credit card debt is going to kill everyday Americans. So people really need to wise up and get lean and mean right now if they want to have any kind of a hope of a happy retirement.
Yeah, no, I couldn't agree more. Couldn't agree with you more. I mean, they can say nice things and the economy is doing this or that, but they're going to have to lower rates. That's the upshot. The pivot's coming, right?
Yeah, the pivot's coming. I think though, if the Feds indeed shrink the balance sheet, continue to shrink the balance sheet, which I suspect they're going to continue doing, decrease the monetary supply, M2, I think that rate decreases most likely could occur somewhere out about a year from now, September of 2024. Although the big 500-pound elephant in the room is, how long does this UAW strike go on? Tomorrow, Friday at noon is when it's supposed to be, some sort of it's being resolved, but I don't see it being anywhere near it. My hometown, where Wright Financial Group is located, Toledo, is home of Stellantis, which is a company of price
largest.
You got
Yeah.
They're nowhere near an agreement here. Nowhere near it.
All right. So what are you supposed to do as an investor, as a saver, all these things? How do you chart a course for survival and even prospering in these uncertain times here, David?
Great question, Kerry. And I think the number one thing that we have to do in their own position is look at what the purpose of your money is for. Purpose over performance, because if you shoot for performance, you're going to try to find that stock that can appreciate, but you may guess wrong. So what you need to do is decide what the money's for. If it's for what most of my clients need it for, which is for income, we find things right now that because inflation is still steady and the treasury, 1-year treasuries are at 5+%, we have people taking advantage of locking in higher short duration things that can get them through this time frame where their money can be, have some principal protection and have some interest paid. Also using things that generate interest and dividends from bond-like securities, preferreds, things like that, of that nature, that even if there's shifts, if I'm wrong and the Feds do raise interest rates, if bond and bond-like instruments drop in value, they don't get the same income. So the person can financially survive through that time horizon where the bond drops in value, but they still get the same payment of income throughout that time period. The bond matures at its value, and the bond-like securities act similar to that. And then the third thing is to take advantage of any long-term plays of money you don't need for income. Look around at some of the mega tech stuff and see if there's anything that you can buy on a dip. Because this IPO that just came out showed the market that IPOs aren't dead. It's been about 16 months since there had been any sort of IPOs in the market. So those are the 3 tips. Money you need for income and stability, short duration securities, treasuries, short-term accounts, and bond-like instruments to provide you dividends and interest. Also, one I didn't mention, dividend stocks. There's a lot of dividend stocks out there. Now, dividend stocks haven't done as well this year next to growth stocks because of the AI movement, but the dividend stocks normally will outperform in this sort of an environment because you're getting paid every quarter. You're getting a nice quarterly dividend check that's going to go back into your checking account. So those are the best tips that I can give. And you know what? I've been in the business long enough with this gray hair, you can tell that I know it works.
Yeah. All right. Here's a question for you. We don't recommend stocks here. I'm not a financial advisor like you, but I've been watching Verizon. Its yield is up to 8%. It's got really healthy cash flow. I mean, they're the number 1 or number 2 cell phone provider in the United States.
Right.
The market maybe is not as much of a growth market as it was, but they've also got their fiber network in the Northeast.
Right.
Do you go for that dividend there? What are your misgivings about it? Put it that way.
I would not be a player necessarily in Verizon full-heartedly, although I would probably hold a smaller position. I think we hold a smaller position in Verizon. You got to be careful, Kerry, that you don't chase a dividend But sometimes you might get yourself into a dividends trap where you're just looking for a high dividend. But I think Verizon's one of those companies, like some of the mega techs, that I think they're kind of too big to fail. I think they're going to be fine long term. But the 8% dividend is certainly compelling.
Do you think they'll cut that dividend? They really can't cut the dividend, can they?
Well, that's what rate hikes do, right? Every time, and Warren Buffett said this, every time interest rates rise, the value of all financial assets decrease. So obviously, if there's no more rate hikes, all of these companies, not just Verizon, they're going to have to cut their earnings. They already did. That's a year ago, they cut dividends. Right. So that this year they could come in and look like, we hit our dividend, we're on target. Yeah, but you cut the dividend last year, by several percent so that you knew you'd be able to match it this year. So obviously, Gary, those things will, have to all self-adjust if rates go higher. It comes in profits.
All right. I like it. All right. So it's wrightfinancialgroup.com. Make sure you click the link in the show notes to this interview on financialsurvivalnetwork.com. While you're there, sign up for your free newsletter. Got one going out any moment now. David, always a pleasure. Thanks for stopping by.
As always, a pleasure.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.